Hi there, my name is Jason Ayers, CEO of the Croft Financial Group and a member of the Investment Review Committee. On behalf of the committee, thank you for taking the time to watch our Portfolio Manager's Brief for September 2021. Well, North American equity markets continue to climb higher through the summer, reaching new record levels in August, marking 10 months without a decline greater than 5% in the S&P 500. This healthy performance can be tied to strong consumer demand, continued fiscal and monetary stimulus, and extremely low interest rates. However, as we move towards the end of September, we are seeing some weakness across the board as investors grapple with the risk of the new Delta variant and what that might mean for the global economic recovery. And most recently, there are added concerns around headlines out of China about Evergrande, considered to be the world's most indebted real estate developer, which is struggling to meet their debt obligations. However, as of the time of this recording, it seems that they have managed to strike a deal with bondholders at the last minute. This, along with the liquidity injection to the markets by the People's Bank of China, seems to have calmed investors for now. As you may have noticed, prices in retail stores are looking a little more costly than normal, as supply chains continue to try to match the demand for everyday goods. Last month, reported annual U.S. inflation of 5% made headlines as being the highest number in a decade, and at 4%, Canada was not far behind. Now, these numbers are certainly contributing to the underlying fear that high inflation may not be as transitory as hoped and is here to stay. However, when you strip out a few of the larger contributors to this number, such as cars, hotel rooms, and more significantly gasoline, which have been highly impacted by pandemic factors, August inflation numbers in Canada are looking more closer to 3%. While the risk of sustained inflation does impact the buying power of corporations and the public, we still do not see this as a long-term concern, but we do caution that the inflation numbers are likely to remain elevated in the medium term as supply chains continue to struggle to match growing demands. Now, looking towards the economic data for Canada and the US, corporate earnings have been very strong, and the job numbers have been promising. That said, there is a clear disconnect between job openings and job demand on both sides of the border, illustrated in this chart reflecting U.S. labor demand as millions of positions continue to go unfilled. The expectation is that this disconnect should be closed as soon as government benefits begin to expire and back-to-work programs gain traction. As such, unemployment levels should continue to decrease to below pre-pandemic levels. At the risk of stating the obvious, the ongoing pandemic continues to pose a significant headwind hindering the global economic recovery, and the spread of the Delta variant has challenged the efficacy of the major COVID-19 vaccines. Given that Israel, a leader in vaccination efforts due to their early start and high participation rates, currently has a higher number of cases and hospitalizations than expected, this new data puts the global economic recovery under pressure. As a result, a third booster shot is currently, and I might add quietly, being administered for those at a high risk for health complications. For more of our insights into this, check out our latest research report entitled Delta Woes, found at croftgroup.com. Now, moving on to central banks and monetary policy, investors continue to closely watch the U.S. Federal Reserve and the Bank of Canada as they dictate monetary policy in the face of economic uncertainty. Now, both central banks have been taking a dovish wait-and-see approach, looking towards the economic data as it comes out before deciding whether to reduce their quantitative easing policies, which would push interest rates higher. And as they continue to buy up debt to lower interest rates for companies and consumers with the intention of supporting market liquidity, central bank balance sheets continue to balloon. And the question on everyone's mind is, just how long can or will they keep this up? Now, investors were provided some insight into this on September 22nd when Fed Chairman Jerome Powell confirmed that they would keep the interest rates unchanged for now, but will start to withdraw support soon. And with investors looking at this as a sign of confidence in the economic recovery, the stock markets are gaining back some ground on the news. After a strong spring, the Canadian dollar has more recently come under pressure relative to the US dollar. Factors include the collapse of lumber prices and domestic pandemic-related economic pressures. In addition, global demand for the US dollar has been strong as investors turn to the greenback for safety, driven by the risk of further COVID-related restrictions and the related global economic impact. And this should bode well for Canadian investors holding US securities. Demand for Canadian government bonds was relatively flat in August. While the demand for US bonds showed some strength, bond yields in general have been on a steady decline since the spring due to both the continued extensive monetary policy and increased demand from investors as they diversify their equity exposure. For our clients invested in our CFG actively managed enhanced mandates, back in June, we rebalanced the mandates away from underperforming momentum-based equity funds and increased allocation to the TCG 531 Conservative Equity Fund. Now, this fund is focused on buying quality companies with consistent earnings and dividends that are trading at a discount relative to the current market, along with well-established tech stocks with promising growth prospects. The CFG Enhanced Balanced and Growth mandates also continue to hold a modest exposure to our Legacies Growth Fund. While the momentum trade has slowed, we believe the technical approach to investing applied to security selection in this fund offers our clients some strategy diversification. For the income portion of our enhanced mandates, given the continuing low interest rate environment, the TCG 534 Income Fund has shifted away from fixed income towards higher yielding dividend stocks and preferred shares. We've also been adding REITs to counteract the recent high inflation numbers, which could continue for the medium term, as mentioned earlier. Our TCG 538 Alternative Strategies Fund continues to seek opportunities in extremely undervalued and overvalued securities, using a combination of stock and option strategies. This fund should benefit from the high implied volatility of the options market based on the continued economic uncertainty. Its focus is to enhance cash flow and act as a diversifier in client portfolios due to its approach being less correlated with the broader markets. Going forward, we will continue to monitor important economic data and rebalance our client portfolios to market conditions accordingly, focusing on delivering strong returns over the longer time frame within your individual risk tolerances and objectives. As mentioned, for more insights, please check out our latest research report posted at croftgroup.com. And as always, be good to one another, stay safe and healthy, and on behalf of the Croft Financial Group, thanks for watching.